Hey, listen, if you're bullish on a stock, there's more than one way to get into the trade than just buying the stock itself. In today's video, I'm going to show you a very intriguing option trading strategy where you can go from, in this example, a $6,515 debit to a $3,475 credit. It's pretty amazing. So if you want to learn about what this strategy is all about, stick around and watch this video. And let's go. All right, everyone, Lee Lowell here from smartoptionseller.com. So in today's video, we're going to be talking about a option trading strategy that will mimic buying stocks, but instead of going from a debit where you're going to have to pay for that stock, you're going to get a nice credit into your account, and it's going to achieve the same kind of thing. So let's discuss and talk about what we're going to do today. So here at the Smart Option Seller, you know that our gig is all about selling put options. All right, that's our bread and butter. That's what we do. But we sell out of the money put options. But today we're going to be talking about selling in the money put options. It's very different than selling out of the money put options. So I have my cheat sheet up here, and we're going to go over, what selling an in the money put option is all about. Then we're going to look at a specific strategy. I'm going to show you where all these numbers that I've been talking about are coming from. Now, for those of you that know, when you sell a put option, basically what you're doing is you're obligating yourself to buy a potential stock at a potential price sometime in the future. Now, that potential price is what's called the strike price. And you as the option seller can pick all the parameters. If there's a stock out there that you like, you don't want to buy the stock at its current price, you can sell a put option at a strike price somewhere lower than where the stock is currently trading and wait to see if you get what's called assigned and have to follow through and buy the shares. So as an example, if the stock's at $100 a share, you don't want to buy the stock at $100. You want to buy the stock at maybe $80 a share, or at least try to buy it for $80 a share. What can you do? You can sell an $80 put option contract. What does that do for you? That obligates you sometime in the future to potentially buy that stock at $80 a share. Stock's at 100. The only way that you'll be able to buy it at 80 is if the stock actually falls from 100 to 80 by the expiration date. If it does, then you will be called upon to follow through and buy your 100 shares at $80 a share. But in the meantime, for you putting in your obligation, you're going to get paid money up front by the put option buyer. So your consolation prize is you're always going to get paid upfront money, and whether you end up buying the stock or not is totally dependent on whether the stock falls to the strike price. Okay, that's what's called selling out of the money put options. That's what we do all the time with the Smart Option Seller in our newsletters. But today, we're talking about selling an in the money put option. So if the stock's at 100, you're going to sell, let's say, a $120 strike price, which is $20 higher than where the current stock is currently trading. So you're obligating yourself to potentially buy the stock at $120 while the stock's at 100. So you might be saying, why would I want to buy the stock at 120 when I can go on the market today and buy it for 100? Well, the reason is because you're going to get a lot of money up front for selling that put option. How much money? Well, you're going to get at least $20 a contract, $2,000 for selling that put option, because that's how far away the strike price is from the current price of the stock. The stock's at 100. You got a $120 strike price. That's $20 right there. So that's a $2,000 infusion of cash you're going to get right off the bat. So that's what's called selling an in the money put option. So why would you want to do that? Well, number one, let's go through the list here. Let's go to the cheat sheet that I have up here. Number one, when you sell an in the money put options, you are very, very, very bullish on the stock, meaning you think the stock's going to start going higher right away. Okay? So instead of buying the stock at the $100 strike price, you're going to sell this in the money put option. Now what happens is that as stock prices go up, put option prices go down. So you as the put option buyer, that's exactly what you want to happen, because when you sell a put option, you're hoping for that option price to go down. Why? Because then you can buy that same option back sometime in the future for a cheaper price. Okay? That's how it works. So if stock prices go up, put option values go down, meaning you as the option seller could turn around and rebuy that option back for a cheaper price. Also, as a seller of an in-the-money put option, you want to choose a strike price with a very high delta. We're going to look at the example. I'm going to show you where you find the delta and what deltas mean and all that. And you're going to choose an expiration date a little longer out in the future, 3, 6, 9 months, 12 months out in the future, whatever you want, because you want to give yourself an opportunity for that stock to actually move in the direction you think it's going to move. Choosing short-term expirations like 1 day, 2 day, 1 week options, it's very risky because the stock could, go in any direction in that short period of time. So you want to give yourself some time to be correct in your stock picking abilities. If you think the stock's going to go up, give yourself a couple months to be right. Okay, so we're going to look at different expiration dates as well. Now here's the real key or the real kicker here with this strategy right now in the current interest rate environment that we have, at least here in the United States. When you sell these very expensive put options, these in-the-money put options, you're going to get a lot of cash for that put option. And what happens is that cash goes right into your account, right into your broker's account. So if your broker is paying interest on that money, you're going to get all this extra interest payments as well. 1 month, 3 month CDs, T-bills, money market funds are all paying around 5% these days. So you're going to get this nice infusion of cash that not only is going to be sitting in your account, but you're going to get some interest on that as well. It's a great thing, 5% interest these days. So I'm going to show you the example of how that works as well. What we want to talk about is there's a couple things we want to go over before we actually look at the example. Selling in the money put options is basically the same thing as buying the stock. So as the stock moves higher or lower, your profits and or losses could build up very quickly. So we want to make sure everyone's clear about that. Selling an in-the-money put option is basically the same thing as buying a stock. It's just that you're going to get cash instead of you having to pay out cash. But the profits and losses come pretty much the same. So if the stock moves higher, you're happy. If the stock moves lower, you're not happy. So you have to be aware that this is a very bullish strategy and you need to be bullish on the stock and you need to make sure it's a stock that you want and that you're happy about owning, okay? So just know that profits and or losses could happen very quickly looking down here. Now, the other thing is that there's not a lot of downside protection. You're basically getting involved in this trade bullishly at the stock's current price. Even though you're selling put options as a way of getting in the trade, there's still not a lot of downside protection. I'm going to show you how you figure out your cost basis here, okay? And the other thing is that down here, there's always a chance of early assignment, meaning that you have to buy the stock before the expiration date. I'll show you how to try to get around that as well. So you have to know that there's a potential that you have to pay for the stock in full at that time. So you need to make sure you have some cash in your account to cover the cost of buying the shares. The other thing is, just as you would with any other stock position, make sure you have a stop loss or some kind of protective measure in place, because if the stock goes down, you're going to start losing money. So you want to have a get out point, a stop loss point. How do you figure that? Well, that's up to you. You can do like a 10% stop loss, a 20% stop loss, or based on how much money that you're losing on the option trade. That's all for you to figure out, okay? And the other thing is that you can always unwind the trade at any time you want. If you sold the put option today, you can get out of the trade tomorrow. You don't have to hold on to it forever. Okay, so I want to get all these, these caveats and these notes out of the way. So what we're going to do is we're going to look at an actual example, not a real trade recommendation. This is not real advice. This is just an example only. We're going to be looking at an example of selling an in-the-money put option on Micron. Okay, here's the example right here, some numbers, and I'm going to show you exactly how it works. So let's take a look at Micron here. Let's look at the chart first. So let's just say, you're bullish on Micron. You don't want to buy the shares. You want to sell an in-the-money put option because it's going to achieve the same thing, but you're going to get paid cash instead of you having to pay out cash, all right? So here's a daily chart of Micron, just an example to show you why you may be wanting to get bullish at this point in time on Micron. It's a great stock. You want to be bullish on it. You want to get involved. So here's the daily chart of Micron. It has this nice ascending triangle here. The stock's been moving up. It has a resistance right around 65 that it was able to blast through. But now it's pulling back down to the $65 area to the prior area of resistance, which should now be support. It's coming up right on the 50-day moving average right here. So you're thinking $65 could be a good place for me to get bullish on Micron. I think it's going to keep moving higher after it bounces off this area of support. So right now, $65 is your potential area where you want to get involved with Micron. So how can you achieve being bullish on Micron without buying shares of stock? Well, let's look at our example. And we're going to pull up our option chain from Interactive Brokers. I use Interactive Brokers. I'll put a link down in the description if you want to get involved or take a look at what Interactive Brokers is all about. If you're already not a customer, you can click on my link in the description. Now, so we're looking at an option chain for Micron. Here's my tab for Micron. And we're going to look at the October 2023 put option that expire in 117 days from now. So that's roughly 4 months from now. Okay. Now what you do when you want to sell an in-the-money put option, you look at the puts. Here's the put options on this side. There's only two columns that you want to look at. You got the bid-ask column right here and the delta column. Now, the key here is that you want to sell a put option with a delta, a really high delta. Now, in this case, we're going to use a 100% delta. Deltas range from 0 to 100, 0% to 100%. So we're going to use the highest delta there is, 100%. What does delta tell you? In simplest terms, delta will tell you how much the option price is going to move with a corresponding jump or drop in the stock price. So if the stock price jumps $1, the put option prices will go down $1 in value as well. That's if you have that's if you have 100% delta. Okay, so if the stock moves $1, the option price will move $1 as well. Okay, so you're going to get the full bang for your buck. As much as the stock moves, the option price will move as well. That's what happens with 100% delta. So we're here in the October expiration. Here's the puts on the right. So we're going to use the first option that has 100% delta. Here's the delta. And we're going to look at the 100 strike put options for Micron. Now on Friday, June 23rd, the Micron 100 put went out $34.55 bid at $34.95 ask. So we're going to do something right in the middle. We're going to sell that put option at $34.75 as our example trade, right in the middle between the bid ask. $34.75 per contract. Based on the 100 multiplier, if you sell one of those contracts, you will get $3,475 to sell that 100 strike put option. Now, what does that do for you? What happens when you sell that put option? Well, not only are you going to get $3,475 deposited immediately into your brokerage account, you've now obligated yourself to buy 100 shares of Micron at $100 a share between now and October of 2023. Now, the last price for Micron is $65.15 right here. If you were to buy 100 shares of Micron, it would cost you $6,515. Now, these are the numbers that I talked about at the beginning of the video. So if you're going to buy 100 shares, you'd have a debit of $6,515. But by selling the 100 strike put option, this deep in the money put option, you're going to get a $3,475 credit instead, which can now start earning interest along with that $6,515, which is still in your account that you don't have to pay out. So you got your $3,475 credit from selling the put, plus your $6,500 is still intact in your account. So you're not only you're getting interest on this new money that you're being brought in, but this $6,500 is still in your account. So you get interest on that money as well. It's a great thing. All right, so we're talking about selling the 100 put. Now let's go back to our cheat sheet here. Look at the example. So with Micron at $65.15, the 100 shares would cost $6,515. If you sell one of these 100 puts with 100 delta, you're going to get $34.75 per contract for it, which is actually $3,475. Now, if you wanted to kind of extrapolate out how much interest you'd get if you're able to get 5% interest on your money for 4 months, it would be about an extra $57 that you get an interest payment on this $34.75 right here, okay? So what happens is you want to be able to understand what's going to happen. Now, if you're obligated to buy Micron at $100 a share while it's currently trading at $65, you're saying, you know, why would I want to buy Micron for $100 while I can go in the market and buy it for $65? Well, because you're going to get almost $3,500 right up front. There's the difference. Okay? So you always want to know what your cost basis would be in this situation. So actually I'll type this, I'm going to show you how to do that. You take the strike price of 100, you minus out your $34.75 per contract. So basically your cost basis is $65.25 a contract. Okay, understand that? $100 strike price minus the premium you received, $34.75 comes out to $65.25 cost basis for Micron if you are assigned in the future. Okay? Now, what happens at this point? After you sell that put option, you've collected the cash, now you basically own 100 shares of Micron. And whichever way Micron goes is how much money you're going to make or lose. So let's just say Micron rallies all the way up to $100 a share by October, which is what you want. Well, this option will be worthless at that point in October because the stocks go up, put option values go down. So this option contract that you sold for $34.75 will now be worth zero. So you could either buy that put option back for, a nickel, 5 cents, $5, and lock in all that profit that you just made on that option contract. Okay? So basically, if Micron goes up to $100 a share, if you had owned the stock, you would make $35 per share on that, $3,500. In this case, the option value is going to go from $34.75 all the way down to zero. So you're basically making $3,475, while the stock owners are making $3,500. You're just making $25 less. But you're able to get that interest payment and you're able to keep the money in your account. So your profits are capped above the stock going above 100. So you have to decide, do you think Micron's going to move above $100 in the next 117 days? You'll have a nice $35 per share profit built up. Anything above $100, as the put option seller, you won't be making any more money. Your profit is capped at that $3,475 that you've made or you collected from the initial trade. So what happens if Micron goes above 100? Well, you won't be participating in any more profits. But one way to get around this, and it wasn't my intention to tell you this, is that what you can do instead is that at the time of selling this put option, what you can do is buy this call option right here, the $100 call option for 24 cents a contract, which is $24. So you can buy that call option at the same time that you sell the put option. And if Micron does rally above 100 in October, well, now you're going to be making money on the call option as well. It's a cheap way to stay in the trade if Micron goes above 100. So there you go. That's how it works. The high delta, the 100 delta, is going to make that option value move just as much as the stock price moves. So instead of laying out your $6,500 to buy your 100 shares of Micron, you're going to get the same results, that same dollar for dollar movement with the stock by selling a 100 delta in the money put option. Stock price goes up, put option values go down. That's what you want as a put option seller. Now, yes, your profits will be capped above 100, but that's a $35 move by Micron in the next 117 days. Does Micron really move that far? That's 4 months, almost 4 months. Here's Micron has been trading, since October between $50 and, $70, $20 move in 4 months. Micron's going to have to go all the way up to 100. Let's spread it out here. Here's 100. Can Micron go all the way up to 100 by October? We don't know. There's just no way of knowing. But if you want to make sure that you're involved in profits, if Micron does go above 100, then you can buy yourself the cheap $100 call. The biggest reason to sell an in-the-money put option is because you will have point-for-point movement with the stock. In this case, you're going to participate in $35 of good movement of the stock. So instead of laying out the debit, you're going to take in a credit and earn that extra interest. And if you want, you can buy the cheap call option. All right, so we go back to our cheat sheet here. This is just another example of how you can use options as a way of getting around making stock trades. Okay, so here's the example here. You sell the October 100 put. It's a 100 delta. Now, the thing is, you could get assigned early, meaning you may have to buy the stock before the expiration date, which means you'd have to come up with $10,000. You buy 100 shares at $100 a share, that's $10,000. So you want to make sure you have, some money in your account because you could be assigned at any time. But the chance of early assignment is very, very low. It really doesn't make sense for the option buyer to exercise the option early before expiration. It just doesn't make sense for them, but you have to be prepared for that. But what I want to show you is that the way that you'll know if you're at risk for early assignment is if that corresponding call option gets down to about 5 cents a contract. Once you're in that 5 cents a contract range, then you're more at risk for early assignment. With the call option being around 24 cents, you're not in any risk then. So you don't have to worry about it. But in that rare chance that you do get early assignment, you're going to have to, pay up for the stock, the $10,000 and buy all the shares. So you need to make sure you have some money in your account, whether it's a margin account or whether you do cash secured, you'll need the $10,000. But that's very rare. Okay? So that's how it works. Selling in the money put options. It's just an alternative to buying shares of stock. So if you don't want to lay out your $6,500, you sell a deep in the money put, you collect the cash, you earn the interest on the cash, and then if you want to buy a cheap call, you can. All right, so that's it. That's how we sell put options or sell in the money put options. If you want to learn about what we do at the Smart Option Seller, and you want to learn more about the actual just put selling trade itself, go to our website, smartoptionseller.com. You can click on our Put Selling Basics link right here. It's our free guide. You could scroll down. You put your name and email address. This is the same form that you'll find around other areas of our website. So you only have to fill it out once. You fill it out. We'll send you an email with a link to download the free copy of the Put Selling Basics ebook. It's all about selling put options. Here's our services. This is what we do at the Smart Option Seller. We have a couple newsletters. We sell put options. We sell put option credit spreads. We have our one-on-one coaching. And if you want take a look at our probability calculator, you can do that right here. And we have, once again, our free Put Selling Basics ebook right here. All right, so what I'm going to do is on the screen, I'm going to put up another video here, our basic put selling video. You can watch that as well. Down in the description, I have some links for some things that you might be interested in. Like I said, Interactive Brokers, I have the put selling link is there as well. And that's pretty much about it. Give me a like, give me a thumbs up, leave me a comment, send me an email. I'll always answer emails. All right, that's all for me today. I hope everyone has a great rest of their weekend, and I will wishing everyone a good trading week ahead. This is Lee Lowell signing off.